All right, Greg is a VP of Alliance Petroleum, Vice President. We're going to talk about the oil market. Greg, give us just a little bit of background about yourself when it comes to the oil business and Alliance Petroleum. I want to get into the projects, some of the technology that you're using, and what your experiences are for the clients.
Well, Michael, I've been in a consulting position in the oil industry for well over 10 years now, and I'm partnered with Alliance Petroleum. We're currently drilling in the Permian Basin, which most of your listeners are probably familiar with, at least the name anyway. We are targeting 4 specific layers of oil in the Permian Basin, which we located in the first 2 wells. As a matter of fact, in the first well, we actually hit a 5th sand or oil formation called the Unicorn that they haven't seen in 34 years. There's never been a better time to invest in oil, especially in the Permian Basin. Anybody that's in this industry, that's where they want to drill. And the reason why is because they have a 93% success rate out there. So we're very excited to be out there.
That is amazing. A 93% success rate in an industry sector where if you hit 1 in 10, you're good. You know what I mean?
That is a very accurate statement.
All right, let me get into some of this stuff. When we were talking before, you were saying that some of the people that you talked to, David Williams, who's on the show here, Market Timer, he's looking for much higher prices of crude oil. You've heard numbers as high as $100. I know you don't believe it, but give us some background of what's behind this. Why are we seeing crude go from the lows all the way up to $70, and some people are saying even higher? What's up with that?
Well, if you do any kind of reading at all on the internet, you'll start seeing articles talking about reserves in the United States being depleted. That's part of what's going on, but what's more important probably to your listeners and anybody that's involved in the stock market, oil and the stock market have had an inverse relationship almost from the beginning of the oil industry.
Yep.
And a prime example of that, in 2007, the market was rallying and oil was at $45 a barrel. In 2008, as we're all familiar with, the market crashed and oil went to $100 a barrel. And that's what the analysts are referring to now as far as their predictions of oil going to $100 a barrel, because the market is poised and ready for a correction.
Okay. All right. So that is so in essence, continued higher prices on oil is what I'm hearing.
I believe that we're going to see $80 a barrel within the next 24 to 36 months.
We had a guy in here, George C., and he has a multi-billion-dollar fund that he works with here in town. He's been around forever. It's, I think, 4th or 5th generation Dallas. And I said, "Hey, George, what are you doing? What you know?" Because he has all kinds of analysts and doing all kinds of things. The only thing he said was oil. I'm buying oil, and he did, and he has been doing good. Now let's get back into the project. You got South Texas, number 6. Number 10, number 3, and then the Shaber. Give me an idea of what you're coming across when you drill into these wells, what you're finding in your areas, and tell me about the field.
Well, my partners and I have been studying these 4 layers of oil for the better part of 5 years. And what's so attractive, and I've had offers to work out in that field, but they wanted me to go in and do workover wells, going in trying to find things that other people missed. But I was specifically interested in drilling in these 4 layers of oil, fresh wells. They're shallow wells. They're only 6,000 feet deep. They don't require all that's involved with a 25,000-foot well. They drill it fairly easily. And we found exactly what we're looking for in the first 2 wells, and we're drilling two more in the next 90 to 120 days. And we're going to drill in the same 4 layers of oil that we found oil in the first time.
Well, how thick are the zones?
The zones, one of the zones is 120 feet thick, which is a huge zone. They range anywhere from 10 to 40 feet.
All right. What do you expect the life? I know you can't accurately predict it, but you can get a pretty good idea. What do you think the lifespan on these things is?
Well, for the wells that we've seen that are similar in the field, these wells can go anywhere from 15 to 40 years. So, and a lot of that has to depend on the experience of the people that are operating the well. If you're maintaining the well and controlling the flow of the well, you can maintain the life of that well for well beyond what some of the other similar expectations are in the field.
Are all four of these wells in the same field? Or are
They are.
Okay.
They are. The wells, the other two wells that we're drilling are offsets to the first two.
Okay. All right. And let's do this. Let's take a brief break right now. I got more questions about the oil business right now, but I want to get out some of the projects so people get a flavor of what it is that you're doing. All right?
Sounds good.
All right. We'll be right back on the other side of this break with Grayson Armistead, Vice President, Alliance Petroleum, talking about the oil business. You've been listening to CEO Money with Michael Yorba. Welcome back to CEO Money. I'm Michael Yorba. I've got Grayson Armistead, Vice President, Alliance Petroleum, on the show with me in the studio, who will be hosting the show for me next week while I'm on assignment in Aspen. All right, Greg, welcome back. Excuse me. I call him Greg because we go back so far, but Grayson, welcome back to the show.
Thank you, Mike.
All right. This segment, we're going to cover some different stuff. Lead me down the primrose path on this.
Okay, so basically, to put this real simply, we drill and develop oil fields with accredited investors, and we do that for profits, of course, also for the active tax deductions. And some people are out there probably thinking, well, what's the tax deduction that's involved? The tax code is 263C, as in Charlie, and basically it dictates that we can write off tangible drilling cost in relation to drilling an oil well. President Reagan put this into effect in 1986 to incentivize domestic oil drilling. And also 15% of the revenue coming back to a partner on one of these projects is also tax deductible. It's called a depletion allowance. And you can run this through an IRA or a 401k retirement plan without any kind of tax consequences or penalties.
Now, that comes with every deal.
Yes.
The hard part is doing what you guys have been doing, hitting the well.
That is the hard part. And I've seen my share of missed wells and poor performing wells. And if people in the industry would talk to you about me, they probably tell you I've gotten old and lazy. And the reason why they would say that is because I no longer drill in unpopulated fields. I want to drill where there's proven development, and my partners and I have a fair chance at making a good profit.
Well, that's all anybody wants is a fighting chance at a fair deal. Now, let me bring this back to the taxes for just a second. Is there a way that, because the way these taxes roll out on these investments, you can actually ladder these so you get a bigger bang for your buck when you come in with the tax deductions by adding more wells onto the old project? Am I hitting on that one right?
You can take up to 90% of the tax deduction in the first year and amortize the remainder over a 5-year period. And as long as we're drilling within a 12-month period, then yes, the ladder effect would be accomplished.
Now, that's kind of a sophisticated way to go out and invest in oil wells. Generally, somebody, they throw the dice at it. But quite frankly, the more sophisticated investors, which is the only people you get to deal with anyway, there's a lot of money on the table right now with the stock market. A lot of people are getting a little nervous, and you know what? We may be time to take some chips off the table. And I've had guys come on the show. One guy, Mike Markowski, to throw a name out there, he was saying, look, 90-10 is where you need to go. 10% of your portfolio needs to be in ultra high risk ventures, either startups or ventures like this. And startups don't give you the tax deduction that you get with this. And then the rest of it in bonds, short term in duration. Are you, in your conversations with the people you do business with, are you starting to get that feeling like, I've taken some chips off the table, I've made some good money over the last 12 years in the stock market, and now I want to do something a little higher risk, but also I need some tax deductions?
Those are definitely conversations that I'm having on a daily basis with the partners that I'm doing business with. And it's simply a diversification, but there's never been a better time, as I alluded to earlier. Anybody that's been in the market for any time at all knows that it's a cyclical market, and we're 3 years past a correction. I don't like when people use the word crash. I don't think it's going to be a crash, but it's going to be a correction. And this is just a wise time to diversify your portfolio.
All right. Tell me about the wells again, because I'm curious about this. These are vertical? They're not horizontal, or what's the story there?
That's right. They're straight vertical wells, 6,000-foot wells. Easy to drill, easy to produce. You don't have a lot of fees associated with producing a 6,000-foot well.
What about the availability of rigs right now? Because I know at one point in time there was a problem getting a rig when the prices started to go up. Are we still in that window where there's not that big markup on the rigs moving them in or leasing them?
Well, it's interesting that you asked that question because when oil hit $26 a barrel, we went from 1,880 onshore operating oil rigs down to about 320. And we're back up now to 900 onshore operating rigs now.
Do you see that there's going to be an issue down the road as we approach $80 or $80 a barrel, 90? Is it going to come in, or did they already cover that on the last roundup with this?
Well, it's like anything else. As the industry is coming back and oil prices are going up, so are the associated support systems in the field. The operators, the refineries, all the associated costs are going up. But with an investment vehicle with up to 80% return on investment, you can still make a healthy profit even with increased prices in the field.
Now, what about the technology? Because we've got higher. I mean, we just had a guest on the show that you can go into a bathroom with your app and never touch anything. So, what about the greater reliability of technology as we move forward to ensure a higher rate of success for your money that you're putting at risk to drill a well?
Well, the technology has increased tenfold. We've gone from 2D seismic to 3D seismic, which is similar to an MRI of the ground underneath the surface in an oil field. But that comes back to what I was saying about drilling in populated fields. Where I'm drilling now, we don't even need 3D seismic to tell us what's going on because we have well control. In other words, there's so many successful wells in the field that we can actually chart and map these oil layers underneath the ground.
How come you're able to get in there and make a profit like you are and not have to muscle your way around with some of the big boys that have huge amounts of money?
Well, it's becoming increasingly hard to do on a weekly basis. Matter of fact, the leases that I originally got involved in was occurred when oil prices it's still in the $50 range, and now that we're up to $70 a barrel, I'm having to pay a lot more for leases in the same field and in the same formation.
Got it. All right. Grayson, we got to run, but thanks for hosting the show, and thanks for being here today. I appreciate it.
I really enjoyed it.
All right, me too. All right, that was Grayson Armistead, Vice President, Alliance Petroleum. That's alliancepetro.com, and you'll be listening to him here 5 days a week next week.